2014. The Monetary Policy Committee met on January 20 and 21, 2014 against the backdrop of uncertainties in the global economy, especially arising from the commencement of the tapering by the Fed. In attendance were 8 out of 10 members, following the retirement of Mr. Mallam, Deputy Governor, on January 11, 2014, and Mr. John Oshilaja, an external member of the MPC, who completed his term on December 31, 2013. The committee reviewed key global and domestic economic developments in 2013 and reassessed the short to medium-term risks to inflation, domestic output, and financial stability, and the outlook for 2014. International economic developments. The global economy is expected to continue recovering from the global financial crisis, as growth is projected to accelerate in 2014. The International Monetary Fund projected global growth at 3.4% and 3.5% in 2014 and 2015 respectively, up from 2.4% in 2013. Some other sources, however, have produced less optimistic projections of global growth for 2014. For example, the United Nations Department for Economic and Social Affairs has projected a 3% growth. The decision by the US Federal Reserve to reduce its monthly asset purchases from $85 billion to $75 billion left most markets stable, having already priced in the development. Quantitative easing measures by the US Federal Reserve have helped to restore momentum to the US economy and also contributed to the improvement of the Eurozone economy in 2013. Europe is forecast to return to growth in 2014 after 2 years of contraction. Greece, which has been at the center of the bloc's banking and debt crisis, is expected to record its first economic expansion in 6 years. Emerging markets that were major beneficiaries of cheap money from the Fed stimulus could experience financial market instability as tapering begins, although the US authorities have made it clear that they remain sensitive to the impact of their domestic policies on global markets and will therefore aim to minimize disruption. Global inflation is projected to rise to 2.71% in 2014, up from about 2.3% in 2013. Favorable developments in food and fuel supply will moderate upward pressure on prices of major commodities, despite the expected acceleration in global activity. The US recorded inflation of 1.5% in December, up from 1.2% in November 2013. Most central banks maintained a cautious posture in 2013, retaining or varying policy rates only slightly. The financial markets expect monetary authorities to continue with policies aimed at supporting growth in 2014. In effect, monetary conditions are likely to remain easy in key advanced economies over the short to medium term on the back of forward guidance that monetary authorities in these economies have given with regard to the conditions that must be met before any change in policy stance comes into effect. Domestic economic and financial developments. Output. The National Bureau of Statistics estimated real gross domestic product growth rate of 7.67% for the fourth quarter of 2013, which was higher than the revised figure of 6.81% and 6.99% recorded in the third quarter and the corresponding period of 2012, respectively. Overall, the growth rate for fiscal 2013 was estimated at 6.87%, up from 6.58% in 2012. The non-oil sector remains the major driver of growth, recording 8.73% in the fourth quarter of 2013. The growth drivers in the non-oil sector remain agriculture, wholesale and retail trade, and services, which contributed 1.64%, 2.34%, and 2.66% respectively. The relatively robust growth performance, despite sluggish global recovery, reflected the continuing favorable climatic conditions for increased agricultural production, sustained outcome of banking sector reforms, and macroeconomic stability. Prices. The moderation in inflationary pressure, which began in the fourth quarter of 2012, continued in 2013. The year-on-year headline inflation fell consistently from 9% in January to 8.6 and 8.4% in March and June respectively, before ending the year at 8%. Also, food inflation, which constitutes 51.8% of the CPI basket, declined from 10.1% in January to 9.5, 9.6, 9.4, and 9.3% in March, June, September, and December, respectively. However, core inflation initially declined to 7.2 and 5.5% in March and June from 11.3% in January, but rose during the second half of the year to 7.4 and 7.9% in September and December 2013, respectively. The moderation in domestic price level was largely due to the tight monetary stance coupled with relatively stable exchange rate regime during the period, which resulted in single-digit inflation in the three measures for the whole year. This is the first time the country has achieved this since 2007. The committee noted with satisfaction that the year-on-year headline inflation remained within the indicated target range of 6 to 9% in the second half of 2013. However, the committee noted the underlying pressure on core inflation, which may not be unconnected with the widening spread between the official and BDC exchange rates. In order to head off the spectre of rising inflation in 2014, concrete actions will be needed to stabilize the currency and minimize the divergence between the two segments of the foreign exchange market: monetary, credit, and financial market developments. Road money supply contracted by 4.82% in December 2013, over the level at end December 2012, in contrast to the growth of 16.39% in the corresponding period of 2012. M2 was also below the growth benchmark of 15.2% for 2013. Aggregate domestic credit grew by 11.11% in December on a net basis, over the end December 2012 level. The aggregate domestic credit net at end of December was however below the provisional benchmark of 22.98% for 2013. The decline in M2 was due mainly to decrease in net foreign assets by 5.86%. Interest rates in all segments of the money market reflected the liquidity conditions in the banking system. At the MPC meeting of November, the monetary policy rate was within at 12% with a symmetric corridor of plus and minus 200 basis points, thus effectively maintaining the SLF and SDF rates at 14 and 10% respectively. Alongside using cash reserve requirement of 12%, the 50% CRR on public sector deposits was retained to address excess liquidity in the banking system. Consequently, both the weighted average interbank call and OBB rates opened at 11.73% in December, but closed at 10.86 and 10.46% in December 2013, respectively. The capital markets continued its rally, with the equities market providing the lead. The all-share index increased by 47.2%, from 28,078.81 on December 31, 2012 to 41,329.19 on December 31, 2013. Market capitalization increased by 47.4%, from 8.97 trillion naira to 13.23 trillion naira during the same period. Improved earnings and investor confidence in the macroeconomic management contributed to the rise in stock prices. External sector developments. The end period exchange rates remained stable at the W, RGAS, and interbank segments, but depreciated significantly at the BDC segment. The exchange rate at W and RGAS spot in 2013 opened at 157.33 naira to the dollar, including the commission, and closed at 157.26 naira to the dollar, representing an appreciation of 7 kobo or 0.04%. The interbank selling rate opened at 156.25 naira to the dollar and closed at 159.9 naira to the dollar, representing a depreciation of 3 naira 65 kobo or 2.34% for the period. However, at the BDC segment of the foreign exchange market, the selling rate opened at 159.5 naira to the dollar and closed at 172 naira to the dollar, representing a depreciation of 12 naira 50 kobo or 7.84%. Gross external reserves as at December 31st, 2013 stood at $42.85 billion, representing a decrease of $0.98 billion or 2.23% compared with $43.83 billion at the end of the previous year. The committee noted that the decrease in reserve levels resulted largely from a slowdown in portfolio and FDI flows in Q4 2013, resulting in increased funding of the foreign exchange market by the CBN to stabilize the currency. The committee again expressed concern over the continued depletion of the excess crude account, which balance stood at less than $2.5 billion on January 17, 2014, compared with about $11.5 billion in December 2012. This absence of fiscal buffers increased our reliance on portfolio flows, thus constituting the principal risk to exchange rate stability, especially with uncertainties around capital flows and oil price. The committee's considerations. The MPC welcomed the sustained stability of the exchange rate and single-digit inflation in 2013. It, however, identified 4 key concerns for policy in the short to medium term. 1. Depletion of fiscal buffers following the continued decline in oil revenue, rundown of reserves, and depletion of excess crude savings. 2. Falling portfolio and FDI inflows. 3. Widening gap between the official and BDC exchange rates. And 4. Creeping increase in core inflation. On the depletion of fiscal buffers, the committee decried the continuous fall in revenue from oil, despite stable price of oil and production in 2013. Although the committee acknowledged output losses due to theft and vandalism, this could not wholly explain the magnitude of the shortfall in revenue. As a consequence, thereby the committee therefore blocked revenue leakages and rebuilt fiscal savings needed to sustain confidence and preserve the value of the naira. The MPC also noted the reduction in portfolio inflows driven by the commencement of the QE3 tapering by the Fed, transition concerns at the CBN, and continued depletion of the ECA, thus dampening investor confidence. The reduction of the US stimulus, especially, would in addition trigger capital flow reversals and put greater pressure on the naira exchange rate. The committee also expressed concern about the widening gap between the official and the BDC exchange rates, noting that this could precipitate speculation and round tripping. Though the BDCs represent a small component of the foreign exchange market, the widening spread appeared to have fed into creeping increases in core inflation. The committee reaffirmed its commitment to a stable exchange rate regime, while urging the fiscal authority to provide support by reducing fiscal leakages, improving controls around oil revenue, and reviewing terms around production sharing agreements with oil companies while awaiting the passage of the Petroleum Industry Bill. The committee also noted the necessity for a complementary monetary policy response to ensure sustained exchange rate stability and convergence of rates in various segments. In the light of this, 2 options were considered. A. Allowing a depreciation of the currency to avoid further tightening and depletion of reserves. And B. Maintaining our commitment to currency stability while stressing that monetary policy is almost at its limit and needs support from the fiscal side in the form of excess crude savings if currency stability is maintained into the future. The committee decided that the costs of a weaker naira far outweigh the benefits to the Nigerian economy and the core mandate of the CBN. It therefore opted to maintain its commitment to currency stability. Furthermore, having looked at all the options, the committee decided against excessive reliance on external reserves to support the exchange rate and opted for monetary tightening until fiscal buffers are rebuilt. Having considered all the issues above, the committee decided as follows. A. All members voted for an increase in CRR on public sector deposits from 50% to 75% with effect from 4th February 2014. B. 5 members voted for a retention of CRR on private sector deposits at 12%, while 3 voted for an increase in this component to 15%. C. 1 member voted for allowing the currency to depreciate by either shifting the midpoint or widening the band. The decision is therefore as follows. The monetary policy rate remains at 12%, plus or minus 200 basis points, and the liquidity ratio at 30%. Public sector CRR increased from 50% to 75%. Private sector CRR retained at 12%. And 4, the Central Bank of Nigeria to take immediate steps to redress the supply-demand imbalance in the BDC segment while maintaining its focus on anti-money laundering activities. Thank you.
Questions? Please have microphone down. Good afternoon, Mr. Governor. My name is Mallam from AIG. Apparently, you have noticed that there is a widening gap between the BDCs and the WDAS, RDAS, and you have recommended some measures. But, Mr. Governor, this gap suddenly took effect. I mean, this gap was noticed around November, December. What could, anotherly, we know that because of remittances at this point, at that time of the year, the Naira usually appreciates because of foreign remittances to the country. What would you say was the sudden sudden cause of that jump from the Naira in the BDCs from probably 159, 160 to 172 at the end of the year?
Yeah, no, I think that part of the answer to that question is that we made a number of interventions that were aimed at addressing suspicions of money laundering. These included, for example, limiting the amount of dollars that banks will sell to BDCs to 250 million naira to $250,000, I think, to a BDC per week. Now that obviously disrupted the equilibrium in that market because it created a shortage of supply given where they were before. And we now have to look closely at how to begin to address that imbalance. What we need to do is make sure that we do not become a disruptive force as we try to fight money laundering, but at the same time we do not allow the market to get to a level where there is no control over the use of foreign currency. So ultimately, I think in the next few days we will see administrative measures aimed at reversing some of the supply-demand discrepancies that have come as a result of our own administrative actions, while strengthening the surveillance and other market-friendly approaches to checking money laundering. I should also say that there are a number of policies that push demand to BDCs. So, for example, you have a number of products that cannot be imported legally, like furniture. And we all know that the people who buy furniture just go and buy their dollars outside the banking industry, or a 100% tariff on rice. Many people will simply not establish an LC to import rice if they're going to be a duty of 100%. They would rather buy forex from the parallel market and smuggle the rice through the Republic of Benin, which is what has happened. The tariffs simply are not working. So there is the issue of complementary trade and tariff policies as well, adding pressure to the demand in that segment.
Good afternoon. My name is Elisha Balagugu. I report from Bloomberg. You just spoke about the chance of further tightening this year. And the question is, do you see that happening before you leave in June? And also, how big outflow do you see now that the Fed has started tapering?
Well, we haven't seen much of an outflow. What we saw, frankly, was just a reduction in the inflows, which should be expected given the fact that, well, one, you have Fed tapering and therefore high yields in less risky environments. You also have concerns about transition of the leadership of the central bank and general uncertainty. So what would expect that kind of reduction at this point in time? As for tightening, my view has always been that we have not come to the end of the tightening cycle. Now, the central bank should continue tightening so long as tightening is required. Now, obviously, there's a limit to how much you continue raising interest rates or increasing CRR. We do need some support from the fiscal side. Now, if the current discussions around the MPC improve governance around the fiscal side and improve retention of all revenues, that should make it easier for us to continue to maintain stability without having to raise interest rates. But if we don't have our own savings and we have to rely on foreign portfolio inflows, we must remain aware of the fact that monetary policy has to provide an environment that is conducive to that. You have to give up some of your monetary independence because you can't have an absence of capital controls and at the same time monetary independence if you want a stable exchange rate. So this is classic monetary policy trial, and that's where we are. Will I enjoy seeing tightening before the end of my term? I don't know. I'll see what happens in March and I'll see what happens in May. If we need to tighten, we'll tighten. If we need to remain where we are, we'll remain. It's just not very likely that we're going to see any kind of accommodation in the year before an election and with excess crude savings where they are.
Good afternoon. My name is Nyuaj for Business Day newspaper. Governor, it's good to hear you talk about tightening rules and improving surveillance with regards to how foreign exchange is traded. I say this because the last time, one of the measures that CBN introduced was the ARUDAS, reverting to ARUDAS, which were told make for more accountability, where people that come to demand for foreign exchange dollars, give account of who they are selling those dollars, to their customers. But we see that the politicians are still doing their thing. I've just been a road change operator just confirmed to me before we got here that right now the dollar in Abuja today, exchanges for $174. If you want to, sorry, naira now, if you want to buy. And I asked him why. He said, the politicians, are buying up, everything, are buying up dollars, meaning that I don't know whether to say that reversion, to ARUDAS hasn't worked, or what do we do next?
Well, first of all, I think ARUDAS is clear, the customers are identified, and ARUDAS is not a window for politicians to buy dollars. As for the comment on politicians, as you know, I have the highest respect for the political authorities, and I will not make any further remark on that.
Governor, sir.
Yeah.
My name is Cliff. I report for NTA News 24. Governor, the Monetary Policy Committee meeting called our attention to the depletion of the fiscal buffers or reserve, as the case may be, pointing to the external reserves and the ECA. In spite of the fact that there is increase in oil prices. My question is, what is responsible for this? Because we expect that there should be a meeting point or understanding of collaboration between the monetary policies and the fiscal policies. So we would like clarification on that and what the central bank is doing to put that in check.
It's a fiscal issue, it's not a monetary issue. And all we've done is to point out a reality. We had $11.5 billion in excess crude savings at the end of 2013. We have less than $2.5 billion at the end of 2014. And that is a fact. And therefore it is a source of concern to us, and source of concern, I'm sure, to the finance minister. And I suppose ongoing discussions will begin to reveal some of the reasons for that decline.
Governor, sir, I know that the central bank is supposed to play a role in ensuring that Nigeria has very reasonable reserves or build up its buffers. And I want to believe that you're taking action in that direction. And secondly, an issue point is the reconciliation of non-remitted revenue from oil. The MPC remitting this or not remitting that. There's been a lot of misconception about that. Why they say 10-point-something billion is yet to be reconciled. I don't know what is really the true position, because I know it's been work in progress. What is the position now?
It is work in progress. That is the position.
Mr. Governor, good afternoon. Nancy, I am for the coalition. Mr. Governor, late last year, the CRR was increased to 50%. At this meeting now, 75%. At this meeting, it's now 75% of public deposits. Can you just tell us why the increase and perhaps the impact of the 50% last year, perhaps it didn't work? Then the other thing is inflation is gradually trending upwards, 8% according to the MBS for December 2013. Where does it leave the central bank right now? Because it seems that this year will be a tough year for you before you go, the way I'm saying it, because inflation 8%, gradually trending upwards. FX reserves declining, ECA depleting, Nigeria's budget contracting. It's really going to be a tough year for you for this year. And what's your outlook for this year?
Yeah, I mean, look, I wouldn't say inflation is trending upwards. I mean, you move from we haven't been in this space for a very long time, and frankly, 7.8 or 7.9 and 8%. Month on month is from 1 month to another. You wouldn't call that an upward trend. We've not seen a continuous trend. In fact, we do think that in the first quarter of the year, we should begin to see some moderation from the 8% we're at, subject to, obviously, our ability to achieve the convergence we want and bring down the very high BDC rates, which are an important component in our forecasts for inflation. Yes, it will be a difficult year for 2014. Will be difficult for a number of reasons. There are a number of external developments. Obviously, we've had the benefit of a lot of inflows coming in as a result of QE all over the world. And this is a year in which we begin to see the easing of the QE, in other words, or rather taking of the QE and generally tighter monetary conditions than we've had in the last few years. Now, as the inflows begin to slow down, we need to be able to retain our own oil revenues. We need to be able to stop the theft, stop the vandalism, stop the leakages, and basically save our own money in order to build up the reserves. Now, it's a fiscal issue because oil prices are an average of $110 plus. Less than the collapse between, or the decline between 2012 and 2013 was less than $2 a barrel. There's actually no reason why oil revenues should have collapsed from 8 trillion to under 7 trillion in 1 year when price and output did not collapse. And so we need to basically tighten those controls. And this is the point we've been making. We need to tighten the controls. We need to check what is the right assignment, where is the money going, and we've got to find it. And if we can do that, it's within our control. That is really the biggest irony here. This is not a case of facing a collapsing oil price, facing the crisis we faced in 2008, 2009. This is really, all of it is internal. It is theft in the Niger Delta, it is leakages in official oil sector. It's something that we can control as a country, and therefore it's a good place to be when you actually are able to take charge of the situation. So it will be tough for us, it will be tough for the fiscal authorities. There's an election coming up in 2015. One of the good stories about not having a lot of money in the excess crude account is that there isn't enough ammunition to spend. Even if you wanted to spend it, the money is not there. So from a monetary policy perspective, there isn't too much fiscal firepower available, and that is helpful. But if we continue having a reversal of flows and pressure on the exchange rate, and we don't have our savings, then ultimately even our commitment to exchange rate stability cannot be indefinite. Monetary policy has limits. Beyond the point, something has to give. There's a limit to how much MPR can go, there's a limit to how much CRR can go. Beyond the point, you have to let the naira drop. And we know the consequences of that on the stock market, the consequences of that on inflation, the consequences of that on the banking system, and therefore we have a stability that is very good, but that is fragile. But we can make it strong by improving our own fiscal position and building our buffers. That's all I'll say.
Okay, thank you.
As foreign investors took advantage of a favorable domestic economic environment, accounted for the upswing in capital market activities. Generally, equity market valuations remained close to their long-run median, suggesting that the stock valuations were close to economic fundamentals. External developments. The naira exchange rate remains stable at the wholesale and retail desk and interbank segments of the foreign exchange market. The exchange rate at WDAS during the period opened at 157.31 naira to the dollar and closed at 157.63 naira to the dollar, representing a depreciation of 32 kobo. The average official exchange rate during the period was 157.38 naira to the dollar. The interbank selling rate opened at 160 naira and closed at 158.65, averaging 160 naira 0.15, representing an appreciation of 1.35 naira for the period. However, the BDC segment of the foreign exchange market, the selling rate opened at 162 naira to the dollar and is currently trading at about 167 naira to the dollar, reflecting the impact of reduction of dollar supply to this segment as part of the central bank's anti-money laundering measures. The committee noted the increase in external reserves to $45.37 billion as of November 15th, representing an increase of $1.26 billion or 2.85% above the level of $44.11 billion as at end of September. External reserves increased by $0.95 billion or 2.14% on a year-on-year basis over the $44.47 billion at end November. The committee continued to express its disappointment at the low rate of reserve accretion in spite of strong oil prices, which is a result of the absence of fiscal savings. The committee's considerations. The committee recognized the importance of taking into consideration not just the static indices at the point of meeting, but overall strategic objectives and targets, as well as the outlook for the domestic economy and the external environment, especially with this being the last meeting of 2013. The committee noted the decline in inflation and the benign outlook going into the first half of 2014. It also noted the positive impact of monetary policy in engendering a stable exchange rate regime and attracting portfolio investment, thus driving the strong recovery of asset prices on the Nigerian Stock Exchange. It noted that global monetary conditions were likely to remain loose going into Q1 2014 for a number of reasons. First, in the USA, it is clear that the incoming Federal Reserve Chairperson, Janet Yellen, does not see tapering as imminent, given the ongoing disputes around the budget and the weakness of economic recovery. In England, although recovery appears to be firmly on track, the Bank of England is clearly not going to consider raising rates until unemployment falls to 7%, probably in late 2014. The Bank of Japan is likely to continue with QE until inflation reaches its 2% target, which is a long way off, and the European Central Bank has just lowered its benchmark rate to avert the risk of deflation. For these reasons, the committee does not anticipate any major internal or external shocks before its next meeting in January 2014. The MPC also noted that AMCON is expected to reduce its debt by 1 trillion naira in December 2013. The central bank has directed that AMCON redeem its bonds for cancellation by exchanging them for FGN treasury bills on its books. Consequently, the only impact of the repayment is that the balance sheet of AMCON and the contingent liability of the federal government from its guarantee of AMCON bonds will shrink by 1 trillion naira. This is positive for the economy and the credit rating of the federal government and the banking industry. Its impact on the markets will be minimal, given that only AMCON's balance sheet is affected significantly, and AMCON is not a player in these markets. The outlook for 2014, however, portends some potential headwinds that may lead to further tightening in monetary conditions. It is expected that 2014 will be the year for QE tapering in the US and interest rate rises in Europe, both of which will lead to some pressure on the exchange rate and stock prices due to the impact on capital flows. It is also the year in which election spending is likely to take place domestically, thus bringing more pressure to bear from the fiscal side. As a result, the MPC is of the view that we are not yet at the end of the tightening cycle and may need to tighten further in response to these eventualities next year. The committee also noted that while the federal government spending overall in 2013 has not been significantly higher than in 2012, all revenues have continued to decline in spite of relative stability in oil price and output when compared with preceding years. As a result, excess crude savings have fallen from about $11.5 billion at year-end to less than $5 billion on November 14. External reserves have remained in excess of $45 billion only because of a massive inflow of portfolio funds. The implication of this is that financial markets are extremely fragile and susceptible to external shocks. The MPC again calls on the fiscal authorities to rebuild buffers in the excess crude account, and this can be done by blocking fiscal leakages in the oil sector and increasing oil revenues. The major risk on the fiscal side at present is not one of escalation of spending, but loss of oil revenue. Finally, the committee formally adopted an inflation target of 6 to 9% in 2014. It also noted that ECOWAS heads of state have set a 5% target at the Convergence Council. The MPC reaffirmed its commitment to moving Nigeria firmly into being a low inflation environment in the medium term.